Deductions, bad debt. If you pay tax on a sale and then cannot collect all or part of the amount due to you for that sale, you may claim a deduction for the taxable portion of the bad debt. You must first charge off the bad debt for income tax purposes, or if you are not required to file income tax returns or you file income tax returns on a cash basis, charge it off in accordance with generally accepted accounting principles. You should claim the deduction on the tax return for the period in which you found the account worthless and charged it off. Deductions, bad debt. If only a portion of your original charges were taxable, you may deduct only a like portion of the bad debt. First, you must determine the taxable percentage of your original sale. Taxable portion divided by total charge equals taxable percentage of total. Next, apply the taxable percentage to the total bad debt to determine the allowable bad debt deduction. Deductions, bad debt example. Deductions, bad debt. If the tax rate has changed since you originally paid tax on the sale, you will need to make adjustments in your calculation. Please call CDTFA for assistance. If you collect payment from your client after you have claimed a bad debt deduction, you must report and pay tax on the taxable percentage of the amount collected. You cannot take a deduction for any amounts you paid a collection agency to collect a bad debt or for related legal fees or court costs. Deductions, bad debt. If you are the retailer of materials and fixtures furnished in a contract to improve real property, you may take a bad debt deduction for bad debts related to that construction work. Otherwise, you may not take a bad debt deduction for unpaid amounts related to charges for improvements to real property. The rules regarding bad debts are somewhat complex. Before you claim a deduction for a bad debt or pay tax on an amount you received after you claim a bad debt deduction, you may contact CDTFA for help.